Jason Schenker, Prestige Economics. Good morning and thank you for joining us, Jason.
Good morning. Great to be here today, Alex.
So Jason, first of all, we did see major sell-off when it comes to the tech sector, which is continuing through European trading session. And previously we saw the same situation in Asia. What's driving the price action? Do you think it has anything to do with possible inflationary pressures or at least concerns in regards to the inflationary pressures to the upside?
Yeah, well, look, this is a key situation we're going to see in U.S. data this week. The consumer price index is likely to show very strong inflation on a year-on-year basis, producer inflation even stronger. So, with a lot of inflationary pressure out there, we're going to see a lot of different financial markets impacted. We're likely to see the bond markets impacted, where we see yields rise, prices fall. We could also see even the greenback strengthen on expectations that maybe the Fed won't be as dovish as they've been communicating that they will be.
So, in fact, the Fed is extremely interesting topic. We're going to be discussing the Fed in a very while, but what's your take on the labor market? I was wondering, we saw the NFPs last week certainly well below expectations. And what are your expectations from today's jobs? Overall, we can conclude that in the US there is more job offerings rather than demand for jobs.
Well, right now we're seeing a few different mixed dynamics in the labor force, where we're seeing some of the strongest demand for jobs in, say, manufacturing and supply chain and in other areas that are really strong. That's not where some of the jobs have been lost and shut down because of COVID. The areas that are most negatively impacted have been tourism, travel, hospitality, leisure. Now, that's an area where we saw big job creation in the April numbers, but does that continue going forward? At what pace? Those are kind of the bigger questions. Right now, there are still 16.2 million Americans, around that number, collecting unemployment benefits in the United States. That's a lot of unemployed people, and that number will go down as COVID vaccinations increase, tourism, travel, entertainment all open up, but it's going to probably be a little bit slower than the most optimistic expectations. It's going to take a little.
And do you think this is because of the Biden administration one-off direct checks?
No, I don't think that's the major issue here. I think the major issue is that a lot of the unemployed people work in sectors where there still isn't work, right? Or they work in a sector where there's not enough work to do. I think, for example, of waiters and waitresses, where in the United States, you're paid the federal minimum wage in the United States if you're a waiter is $2.13 an hour. And that's usually withheld by employers as tax money. It means you don't get that, right? It's only $2.13 an hour. It means you get tips. That's your biggest source of income if you're a waiter. Well, are you going to go and wait tables if there's no one in a restaurant? Of course not, because your income comes from tips, not from what the restaurant pays you. So for some jobs like that, they're going to wait until the restaurant's full before they go back to waiting tables again. That's something that you're going to see for some industries. Now, there are other industries that aren't tip-oriented, that have that don't have such a low minimum wage, but a lot of companies are still probably going to be a little bit slower to hire going forward in those distressed industries that were so adversely impacted by COVID.
Final question, and it's in regards to the Federal Reserve. Do you think they're going to switch, in the meantime, their monetary policy, starting with some kind of tapering?
Well, I don't necessarily think that that's going to be a switch of policy. I think that what we might see is, with higher inflation numbers, the Fed members might begin to communicate that they're going to begin seeking alternative paths forward, rather than the most dovish scenario they have out there, which is no rate hikes until 2024. That's from the March forecast from the actual Fed members. So as we look forward, what do we expect they're going to do? They're probably going to say they're going to continue to remain dovish and accommodative, but that's just a very tough story to have people believe when inflation numbers look like 3.5% or 4% year on year. It's just it's a story they've been telling. It's just, will it be believable with a lot more consumer inflation, even if that's a transitory inflation rate? That's the question I think there's going to be doubt there, and that could cause bond yields to rise and the dollar to rise as well.
All right, thank you very much, Jason Schenker, President, Prestige Economics. Thank you for joining us, and have a great day ahead.
Thank you, Alex.